The numbers on your chalkboard are not stock prices. They are proofs. You are 23 years old, earning $48,000 a year, and you have never worked a day in finance. That is exactly why they want you. Level 1, the PhD student. The program is 5 years, sometimes 6, mathematics, statistics, or physics at a school whose name matters. MIT, Princeton, Stanford, Chicago, Caltech. The stipend runs $48,000 to $65,000 a year. Tuition is waived. The health plan covers the essentials. In the city where your program sits, that stipend means one roommate and a budget that you stop revising after month 4 because revising it doesn't help. Your job is to prove things, not to build models, not to generate anything measurable in quarterly terms, to prove things. You teach undergraduate calculus 2 days a week to keep the funding active. Your real work happens at the edge of 2 fields that don't yet share a vocabulary. That boundary is your thesis. Year 2, your first published paper, a result in stochastic processes, narrow and precise. It will be cited by 14 other papers in the next decade, most of them in fields you have never worked in. You will not track this. Year 3, the thesis begins to have a shape. You know the answer before you can prove it. The gap between knowing and proving is where you live. It occupies you in ways that feel total and normal at the same time. Year 4, a conference in Boston. You present the first chapter of your dissertation. 40 people in the room. 36 are academics, 4 are not. One of the 4 finds you during the coffee break. He hands you a card, no firm name on it, just a name and an email. He says he read your preprint on high-dimensional Markov chain structures and that it was interesting. He uses that word the way someone uses a word when they mean something they are not ready to say directly. You email him that night, the first call comes 2 weeks later. They ask about your research, your timeline to defense, whether you have thought about applications in environments where noise distributions are not Gaussian. You say you have not. You say yes anyway. You don't know the firm's name. You don't know what it manages, what it trades, how many people work there. You only know that someone outside academia has read your work and thinks it is worth a phone call. You have been in this building for 4 years. That has not been true until now. Your defense is 7 months out. The card is in your wallet. You go back to the proof. What you don't know yet, you passed the first filter 3 months before you knew there was a filter. The call was not introductory. It was evaluative. There will be 6 more before anyone uses the word offer. Level 2, the junior quant researcher. There were 6 more calls. Then 2 days of on-site interviews. Probability problems, a combinatoric session that ran 90 minutes, a room where a senior researcher handed you an unfamiliar derivation and watched how you moved through it when the answer wasn't there. You got most of it. They didn't tell you how much. The offer arrived 3 weeks later. One of the names you have learned to take seriously, 2 Sigma, D.E. Shaw, Citadel, one of the systematic houses that treats a mathematics doctorate the way Goldman Sachs treats a Wharton MBA. Total first-year compensation is $420,000. Base, $180,000. Signing bonus, $80,000. Guaranteed performance bonus, $160,000. You run the number 3 times. You deposit the signing check and feel something close to disbelief, then nothing, because the number has no frame of reference yet. You are 27. The office has 20 researchers managing $6 billion. No open floor, no squawk boxes, no hum. People at desks with dual monitors and notebooks open beside keyboards. The quiet sounds like a university. The output does not. Your job is to find signals. A signal is a statistical pattern in data that predicts future price movement with an edge that survives transaction costs and decays slowly enough to be worth deploying. That definition sounds clean. The work is not. You spend the first 3 months reading academic literature on factor models, alternative data sourcing, market microstructure, risk premium frameworks. You annotate everything. Nobody asked you to. You do it because the annotations are how you build the map of what has already been tried and failed. Your first signal memo takes 3 weeks. Satellite imagery of retail parking lot occupancy correlated against same-store sales surprises. Back-tested Sharpe ratio of 1.4. You present it in 11 minutes. The portfolio manager reads the one-page summary in 4 minutes. He says one word: pass. No explanation. You spend 2 days trying to find where it broke. You never do. Your second memo: a volatility pattern in currency pairs during the 15 minutes following European Central Bank communication windows. 12 weeks of work. The PM reads it. He says, interesting. You find out later that interesting is the best word he has said to any researcher in 6 months. The signal goes into the book. It runs 90 days live. It holds out of sample. You never learn what it generates in P&L. Nobody tells you. Asking would signal that you haven't yet understood who owns what. At the end of year 2, someone mentions a number at a team lunch, offhand, the way you mention something that doesn't require context. A signal that a researcher wrote 4 years ago is still running in the book. Cumulative alpha generated $340 million. The researcher left after 2 years. He is at a university in California now, writing academic papers. His signal is still running. It will keep running. It will run after he dies. You don't sleep well that night. You are not afraid. You are doing arithmetic. Level 3, the research scientist. The arithmetic resolved into something you could act on. The signal is permanent. You are not. That asymmetry is not a threat. It is a job description. You are 30. Total compensation this year is $780,000. The number is real, and you have stopped noticing it. What matters is what you are building. You own a strategy now, not a signal, a framework, a systematic structure that trades across 44 instruments in 3 asset classes, combining 31 individual signals under a unified risk model. You did not write all 31. Some were started by researchers who left. You inherited their code, tested their assumptions, found what had stopped being true, and rebuilt from the inside. This is called research. It is closer to archaeology. The central tension at this level is capacity. Your best performing signal has a ceiling of $200 million in deployable capital. Above that threshold, the positions are large enough relative to available liquidity that the signal begins moving the market it is trying to trade. The edge eats itself. You have spent 4 months building something with a theoretical ceiling that limits its usefulness to the firm. You present this honestly. The PM nods once. You go back to the desk and start over. The hours are not brutal the way banking hours are brutal. You work 60 hours a week by choice, not by mandate. The pressure is interior. 6 months can pass where every hypothesis you test fails out of sample. The market changes its regime structure, and the signals that worked in the previous configuration stop working in this one. The work starts over. You write a paper for an internal research conference. It is the best technical work you have produced. Nobody outside this building will ever read it. Then a recruiter calls. Not for a research role, for a portfolio manager seat at a multi-manager fund with 11 billion under management. He says, you would run your own book, your own signals, your own capital allocation decisions. You ask how much capital. He says it depends what you bring. You don't call him back for 3 weeks. When you do, you tell him you are not ready. This is true. You know exactly what you still need before ready means something in a context where the market provides the grade and the grade is permanent. 3 more years, you tell yourself. 3 more years to build a thing before you bet on it. Level 4, the senior researcher. 3 years. You are 33. Total compensation this year is $1.4 million. Your signals run inside 14 active strategies. You did not write all 14, but you understand all 14. You know which are fragile, which are robust, which depend on microstructure conditions that could shift with a single regulatory announcement. You carry the map in your head because committing it to one document would create a security problem the firm takes seriously. The NDA conversation happened again last spring. Not the onboarding paperwork, a different version. The firm's attorneys, a small conference room, 2 hours. Every notebook, every model, every line of code, every signal you have developed here belongs to the firm. If you leave, you cannot work in systematic trading for 2 years. You cannot discuss the firm's methods, data sources, signal architecture, or portfolio construction logic in ways that could be identified as originating here. You signed without reading past page 3. The terms were not surprising. They were the structure. What you understand at this level that you couldn't have seen earlier. The alpha is not in the signals, it is in the combination. The way 31 signals interact through a risk model across different regimes. The correlation structure that holds the whole system together. The portfolio construction layer is where the real intelligence lives. And it is the part of the firm's knowledge base that is least portable, most collaborative, and hardest to reconstruct anywhere else. You have been in the room where that layer is discussed. You understand enough of it to be dangerous. Which is why this conversation also happened. The PM walked to your desk on a Tuesday afternoon and said a book was opening. Your own capital, your own signals. 10% of profits generated. He said the number in the same tone someone uses to read a departure board. You asked for a week, you spent the week building the risk framework you would run, not the signals you have those. The drawdown rules, the regime detection protocols, the escalation procedures for when the model's assumptions are being violated faster than the model can update. You gave yourself 6 days to find a structural flaw you couldn't answer. You didn't find one. On day 7, you walked back to his desk and said, yes. If you've made it this far, you're exactly who this channel is for. A subscribe helps me keep making these. No pressure, but I'd appreciate it. Level 5, the portfolio manager. You are 36. You run $800 million. Not advise, not support, not contribute to someone else's book. Run. Base salary is $200,000. That number was significant at level 2. Here it is. The fixed costs of the arrangement, 10% of profits. In a good year, your book returns 16% on capital. That is $128 million in P&L. Your cut is $12.8 million. In an exceptional year, higher. In a bad year, the base sustains, and nothing else does. Nobody manages you, nobody reviews your memos. Every morning the terminal opens and the positions update, and the update is a verdict on your thinking. You lost $31 million across 9 trading days in February when a volatility regime shifted faster than the correlation matrix had anticipated. Your stomach doesn't drop anymore. That response stopped at month 7. It is a number with the wrong sign that requires a specific sequence of corrective actions. You reduce the positions, you document the failure of the model's assumptions, you update the framework, you go back to work. You are right 52% of the time in this industry. That makes you exceptional. The other 48% keeps you honest. The isolation is real in a way nothing prepared you for. At the research level, you had the feedback loop of a team, a PM's desk, an internal conference. Here, there is only the position and the market's daily verdict on it. The position is a hypothesis. The market adjudicates. You have been doing this for 4 years. Your signals have held through 2 rate regimes, 1 credit event, 1 sustained volatility compression that should have degraded 3 of your strategies and didn't. The machine is genuinely yours. The results are real. And then at a conference in New York you almost didn't attend, a researcher who left one of the original systematic houses 9 years ago says something offhand during a panel. He mentions a number, not as a boast, as a fact the room already knows and has simply agreed to accept. 66% average annual gross return since 1988. 36 years. 0 losing years. You already knew the number. What you were not ready for was how the room received it. Nobody leaned forward. Nobody asked how. The number was accepted the way a physical constant is accepted, as a fact about the world that you operate within and cannot change. You sit with that for the entire flight home. The final turn, 66% for 36 years, is not a number the hedge fund industry produced. It is a number the hedge fund industry has failed to explain for 36 years and has accepted as permanent. The Medallion Fund is not a fund you can invest in. It has not accepted outside capital since 1993. The last external investor was bought out in 2005. Since then, the fund takes only employee money, capped at $10 to $15 billion, to preserve the edge. The 400 researchers in East Setauket, New York, are not competing for access to it. They are inside it. Every improvement any one of them makes to the model moves their own wealth because they are all invested in the same fund. The incentive structure is the architecture. The architecture is the edge. The NDAs they sign are not the ones you signed. The restriction is not 2 years in similar roles. It is permanent and it covers categories of information broad enough that leaving the firm requires leaving behind not just the specific signals, but the framework of thinking about markets that the firm has spent 4 decades building inside its researchers. You will never see the model. There is no conference where it is presented. There is no paper published. The researchers who built the foundational signals are not celebrities. Some of them have been dead for a decade. Their signals are still running. The model incorporated their work and continued without them because the model is not dependent on the people inside it. It is the system. The system is designed to outlast its components. Every systematic fund you have ever studied, every signal you have ever built, every framework you have developed across 15 years of research is a local approximation of something they solved globally before the internet existed. You are not failing to reach Medallion. You were never in the race. The race ended before you understood what winning it would require. Somewhere in East Setauket, in a building that does not advertise its address, a researcher who has not left in 21 years is running a new test on a dataset that does not yet have a name in the academic literature. The result will go into a model you will never see. The model will run for decades after he is gone. Several signals already have. Your terminal shows the Asian session opening. The positions are updating. You check the correlation matrix, review the overnight risk report, scan for signals approaching their regime boundaries. The machine you have built is real. The results are real. The work is real. It is also not the best machine. It has never been the best machine. You go back to work.